Richie, I'm wondering your overview of the market. Very interesting one. Last night we got a Bank of Japan announcement that they will be increasing the interest rates. Sorry, and today afternoon, Jay Powell speech. People were waiting on it, and then finally we got some signals that on September we will see some kind of rate cuts. But there's also too much discussion going on between 25 basis points versus 50 basis points. So what could be the possible effects as an investor, as a trader? What should we expect for the following weeks? We would like to hear from you.
This Fed has history in the last year, last 6 months. And the history is the narrative that's out there, for whatever reason, seems to be fairly accurate all the time. Not more than family. That's not fair. It seems to be accurate. And so what is the world speaking about now? What are the Las Vegas percentages now? They're very high for a 25% rate cut. I think that's in there. I don't think they're going outside the box, especially in an election year, especially exactly what's going on right now with the Democratic convention. And I don't see any surprises, because that would send a really bad signal out there. If they ever cut 50%, it would be against the grain, and it would mean things are really bad. Okay, because they know obviously a lot more than we know. Sure. They're very close to the numbers, not a lagging number from a month ago, but to yesterday. They know these numbers, and so out of left field, if they ever cut 50 basis points, look out below. That's my opinion. Look out below. 25 basis points, to me, we got a few more days. We got a couple of weeks actually, but a few more days, and it could change. The numbers that are coming out between now and then could change their thinking, and may very well change their drinking. But I think you're pretty much locked in at 25 basis points cut, and I think that the market has already rallied. I think it's already in the market. So unless something crazy goes on between today's close and when they announce, I would expect the market to react lower when they come out.
Got it. Thanks for that. What about the Japan yen carry trade?
Yeah.
So in one hand, Japan, which is like third biggest economy in the world. At the other hand, U.S. markets is the biggest economy in the world. So one of them increasing, one of them decreasing. How that could affect on the yen carry trade?
Well, I don't think the world famous carry trade that everybody got smashed in and caused they pulled the plug that day. All right, they pulled the plug because they were all in this carry trade. And what does the carry trade mean? It meant that they were buying, they had holdings on the Japanese yen, and they were leaning against that position and borrow against that position to buy high growth names. And that day, whatever it was, 2-3 weeks ago, they just pulled the plug on the market. The margin calls came in, they killed the Japanese yen. The margin calls came in, and conversely speaking, they had to sell their positions at deep losses in the Magnificent Seven stocks, and that's it. They don't have the Japanese economists are not the smartest dudes on the planet. Let's put it that way. This has been going on for 20, 30 years. They cannot figure out how to balance their yen against their economic situation. They just can't. And you know what? It may be so far gone that it can't, not even possible. So, I don't, you get away with these trades until you don't. And then when you don't, it gets ugly. So if you make, some really terrific trades, one trade could wipe you out and hurt you. And that is preventing a blow up. All right. Prevent blow ups when you're trading. Prevent blow ups. You cannot prevent blow ups with the Japanese yen, because it could hurt you. It could just hurt you. So, that's my take on that.
Right. Well, whatever decision they make now, I think that it will affect their entire economy, because if the demand on the Japan yen will decrease, that may Japan forex will be decreasing, so the entire economy can get hurt. So it is kind of hard to balance, I think, in this situation for them as well.
Yeah. Yep.
All right. So today our topic is position management, Richie, and I have a couple of questions. And I would like to remind again, if anyone has any question related to the topic or out of the topic, please don't hesitate to put on that chat. Also, you can share your any idea about what you would like to see covered on upcoming sessions. You can put that on the chat as well. So to kick things off, Richie, my first question is about how can technical indicators inform decisions about adjusting or exiting open positions while maintaining mental discipline? Should I repeat again?
I mean, no. Listen, technical. Thank you for that. Technical areas are borders, and borders are the whole game. I draw your attention to, I believe it was yesterday, they featured one of our live sessions. We spoke about the borders. We spoke about the algorithms, and they featured it. And I suggested everybody who's on this presentation here, you should be looking at that, because it was, everything doesn't always come out right, And so I will tell you that. But that one came out, it was very simple and very to the point, and you should all pay attention to it. But in any event, the technical areas are boundaries. It's the whole deal. They're boundaries. The algorithm today was a perfect example. In a lighter trading type of scenario, they took the market up or down. I can't tell you how many trades I made today from a top technical resistance area and a bottom technical support area, and in the middle. I mean, they were beautiful trades, beautiful. Why? Because the volume was lighter, and the algorithms, their whole existence, they want to make sure their whole day existence, day to day, their whole existence is predicated on creating volatility and liquidity. That's it. That's their whole example. That's their whole life existence. So, again, so what happens is it becomes very predictable when you know that you have borders, so a resistance area and a support area. And so on a lighter, calmer day, okay, when the algorithmic get a little itchy and they can't help themselves, okay, so when it comes up to a strong area and the market's not really doing much, it's just upward pressure. They try to find a level where they find supply, and they don't find any supply. But there's a technical area here. There's a premium area up here, and there's a technical area that are right on almost to the exact same number. And those algorithms move up. It's light volume. How they keep going up? You're saying things up. How they keep going up? Well, you know what? In a light volume type situation, those algorithms are going to that technical area. They're going to force it. And they're going to force day traders or individual investors or whatever you want to call us, all right? They want to force them to push them over the top and say, wow, this is a high, but they're going to the moon from here. And then they trap you, you see. That is what's called a failed breakout. And failed breakouts lose 80+% of the time, no matter what. So you try to buy a failed breakout, you're looking for trouble. But those algorithms, when it gets close and an up market gets close to those areas, you need to know the technicals that exist. You need to know where they are. And you need to know that the algorithms are going to go there.
Gotcha. What kind of signals we should be looking for that kind of fake breakouts?
Again, you need to know where the technical areas are. If anybody wants to be clued in on our technicals, you can trade anything with. The technical areas are the technical areas. I mean, they're on our charts. place them on our charts. We know where they are.
Mhm.
And how could you prepare for that?
Yeah.
Well, the movement of the market, your movement of the market, up or down. You know, it's all about the technical areas, right? You know, I mean, you know, the news means nothing. All right, really, the news really means nothing. It's all, you know. Again, I want to go over this again. It's really important, but you know, in this day and age, the position sizes because there is so much money under management at these individual shops and funds that there's no way they just, you know, oh, I'll buy IBM, and 20 years later, you know, and I'll get the dividends and I'll be just clocking money. Great. You know, that doesn't happen anymore for the most, in the sense of the word. For the most part, it doesn't happen. Why? Folks, the enormity of these positions, you cannot just hold 40 million shares of a stock and just say, oh, it's going straight up. No. You know, along the way, they start to hedge up positions like that, mostly in options. That's why we focus on an option market as well. It tells you the story. It tells you where the gamma, it tells you where the delta, it tells you where the strike prices are. And the algorithms are mathematically programmed. That's part of what they do, because it's not only the technical areas, but it's also has to do with where the option strike prices are.
My next question, Richie, is what technical signals should prompt a re-evaluation of your position, and how do you manage your emotions when these signals appear?
You know, the emotions, you're on your own, man, okay? You know, this is just simple breathing techniques, all right? If you're really up against it, if you take 3, 1, let it out. 2, a little deeper, and hold a little longer, let it out. 3, deeper as you can get, hold it, and let it out. Let the air flow through your system. Oh, you think I'm crazy, right? No, I'm not crazy. Trust me.
That's science.
Breathing techniques help calm you down. I'm oblivious to this at this point, to tell you the truth. But 99% of the people out there are not. So, you know, the way you manage your emotion is to be confident in the work you're putting in to get to this point. You see. You need to be a student of the game. You need to practice your trade. Excuse the pun, but you need to practice. You need to be a student of the game. Being a student of the game and putting your work in and preparing yourself every day, that will give you the confidence you need to control your emotions. And that's really it, because once your emotions go, folks, I don't care what your entry price is. I don't care about a thing. But once your emotions go, you're at the mercy of the criminals or the people that are trying to dictate the flow and the direction of the market. Mm-hmm. How do they do that? By getting you to buy bad breakouts or getting you to sell bad breakdowns. Just 2 examples.
Yeah. And what kind of technical signals you're watching in order to evaluate your position?
Okay, well, I have 3 1-minute charts up here. Okay, and they're overlaid by Keltner channels. They're overlaid by the 9 EMA and the volume weighted average. 3 of them next to each other. It could be anything.
Richie, how do you use trend lines and support resistance levels to manage your positions? How do you determine these areas? Based on the previous close or the, I don't know, 52 weeks high or lows? What do you look for?
No, not the weeks high or low. I mean, that's sometimes, but you know, one area, if the market's coming down near a low and it's a technical area and the low is the low for the day, chances are they're not going to break that low for the day on the first time down. Okay, so that's just a little tidbit. So if you come in near a technical support area and it's also around the low for the day, it is the low for the day, chances are they're not breaking that low on that move down. So you have two things in your favor. Forget about the support area that I just spoke about, but let's just say it's the low for the day. That is an area that technically investors look at. If they break the low for the day, it's not a good sign. So they tend to hold that. Okay. And if it happens to be near a support area, well, I would take a larger contract size over there for that reason. If there is no technical area and it's just dealing with the low for the day and holding it, I won't be long. I'll place a smaller bet. Mm-hmm. But there's only one factor in my favor, the way I see it. But if I know there's another factor or the support area, I'll increase my bet in size significantly.
Okay. So you kind of suggest them to average down and average up, or it just depends on your position and.
Okay, so you never want to have a single entry entry. You don't want to use all your ammunition up. I don't care how confident you are. You're going to have to be willing to add to a position if you're early. Sometimes you don't want to miss the market if you're very, strong on where you want to buy it. But, sometimes you're a little early and you don't want to miss it. And you may be early and you could be early. So you don't want to spot the criminals' handles in their favor. So conversely speaking, you have to respect the fact that you could be early. Everybody doesn't buy the bottom. Everybody doesn't sell as top. Those are the people that get hurt. So having said that, you need to be in a position to add to a position if you're early. And I don't mean add down one or two handles because that could hurt you. But prepare to handle if you're playing, let's say NASDAQ, or if you're playing a wild stock that's moving pretty quickly, you don't want to place the second bet close to the first bet. You want to give it some time so you can bring your price down, not down by a handle, but down by, for instance, the NQ, NASDAQ, okay, it's crazy. I won't average the NASDAQ. I'll average the NASDAQ down 20 handles, okay, because I know the NASDAQ can make up 10 or 15 handles like that. So I don't want to keep my positions tight on that. But when the market shows me, all right, that it's coming up and my entry level was good and I didn't add because it really didn't come down much, I won't even hesitate at buying above that entry level and adding on strength because the market is telling me that the worst is over and now they're buying it. And so I can add that strength. And instead of, as it's moving up, I'm bringing my price up somewhat, but the market is going in my favor. So don't ever be afraid of adding on strength. It's a good move under the right circumstances.
So it's kind of depending on the ticker, the stock or index. It's on the situation itself.
Correct.
Okay.
Correct.
Thanks for that, Richie. And actually, it's also touch point with my next question, which is, what are the effective ways to set and adjust stop loss and take profit levels based on your technical analysis?
Well, that's a good question. It's an easy question, quite frankly. It depends where you are in a scenario. Market is way up, way up. It's having a strong day and it's up. And it's near a technical area. And the market is up pretty good, whatever. And you're in a strong resistance area. And they just took the market up and it's coming near the end of, it could be the end of a cycle, okay? And I know that I have this major support, resistance area right sitting above that move. I also may see a premium area on my charts, which is an algorithmic play. They love to go to those areas, you see? So I know in that particular situation, I have different stops. There's no rule of thumb. In this particular instance, as I'm describing here, I am going to keep that tight. I am going to take that situation. I'm going to short this. I'm going to short the vehicle over here, But I know that if it goes through here, it's off to the races because I'm aware of this resistance area or the breakout area, if you will. I'm aware of that. So I can take a trade like that with a much bigger downside than getting hurt. Much bigger P&L position, all right, or chance than here because I know the market has made a nice run. I know there's a technical area here. And I also know that up 3 handles from here, it's going to go and I'm going to be wrong. But I know, and I can keep that stop real tight because the risk reward, because the market has run up, is far greater to the downside. And what am I risking? 3 handles. So, stop orders are not always, you hear people say, a lot of people, limit your losses. That's great. But you don't just snap your fingers and limit your losses. It's predicated on factors. How much are you up? How much are you willing to risk? What's the situation in the market? Is it due for a correction? Is it due to breakout? Those are the things. I don't have a set play to stop myself. I always protect myself, but it's not always. It changes. Yeah. It changes. And the thing.
Sorry.
What's the same thing? Go ahead. I'm sorry. Go ahead.
Sorry. I was going to ask, if you're using trailing stops in your every trade or depending on the special?
It depends how aggressive I'm going to be when I'm going to add to a position. I don't want to get stopped out. If I know I'm going to add, okay. Now in that particular last instance, I know I'm not going to add to that position. The play is the play. What I described to you is the play. I know I'm not going to add, so I don't really care. The play is exactly like I described it. I'm risking 3 handles to make 20 or 30 handles. That's basically the way I look at it. Now, if you're on the buy side of the market, okay, and you're going to add, you don't want to keep your stop so tight, okay, because to me, you're not giving the trade a chance to work. So it's all relative. Like to sum that up, folks, there is no one way to protect yourself with a stop. There's no formula. Okay.
It's so dynamic, as I understand, right?
Exactly. There is no formula. I know. Don't listen to anybody that tells you, well, you should stop always down 20%. Oh, yeah, that sounds great. But every situation is different. You want to beat out this market, all those little nuances mean something. There's no one way in one area. And you can't look at a scale and say, okay, stock is a $40 stock, and I should risk this, so let me protect it down. I'm telling you, that's a mistake.
Gotcha. Yeah, that was a good point. Thanks for that, Richie. Actually, you asked for my next question. It was about moving averages and other technical tools, and you already mentioned that. Last question also we can get from you a wrap-up of the session as we are coming end of our session for today. So how can you combine technical analysis and disciplined mindset to avoid common pitfalls?
How could technical analysis is borders, and they're very important borders. And the borders mean that you're going to play within certain limits. Simply put, borders, that's what they do. When you have borders, there are areas when you can play. Boom, 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 boom. And the borders do change during the day as the market moves up and down, up and down. But the borders are the whole deal. You got to know where the borders lie. You can't have a market without borders. You can't have a market without knowing where the technical borders are, because the algorithms are trained to go to the technical borders. When they come down to an area, they're going to that area. They go up to an area, they're going to that area. And it happens, and it'll happen to the end of time. And that's the way it is. That's really the way it is.
Do you have any final golden nuggets for today's session, or are you happy?
NVIDIA's earnings, the 28th of this month. Okay, so that is going to be a big number. They've already got the stock up 30% from the lows. I mean, is it? Are we off into the sunset? I don't know. Maybe they could do what they want, but this is a company that's. I mean, I don't know when it stops, but the music will stop. That's for sure. you're in an area here where there are buybacks. This is a large buyback time period until like the first week of September. All right. And buybacks, you're talking about billions of dollars are authorized buybacks. Buybacks are cushioning these moves down every day. Billions of dollars, almost $5 billion a day during this time period is used to buy back for company to buy back their shares. And that cushions the downside. Companies can't buy a straight plus tick. They can't pop up the price of their stock. So they have to constantly be on the bid side of the market. Okay. And when on the bid side of the market, there's the cushioning effect. That's it. Algorithms go. They have to be off the floor by 3:50 in the afternoon. And sometimes you'll see a mini puke, I like to call it. Mm-hmm. Sometimes you will see a mini puke in an up market at 3:50 in the afternoon or 3:49 when the buyback orders have to leave the floor. Especially in an up market, you usually get a reaction on the way down. All right, these are day trading type gimmies for you folks, and that's what usually happens in an up market. After that, that the algorithms and that the buybacks were all in cahoots with one another, and they all know it and they all see it. And there are people investors that play that game. Once again, you've got to know what the competition is thinking, always.
That was a real golden nugget from Richie. Lots of it in one sentence, actually. Thank you so much for that. I would like to thank you, everyone, for joining us today. A special thanks to Richie Naso, a real OG, real legend of the Wall Street, and for his valuable insights on the trading mindset. And stay tuned for more TradeZero live sessions.